Welcome to the SoFi show. Okay, today we got big news. Amit, what's up?
Technically, SoFi's up. We hit $9 this week. I don't. Did we end at 9? We got to 9.14 this week, which was really nice to see. And SoFi's now 24 hours on Robinhood, so it wasn't a crazy week in the markets. I think S&P ended at like 446 or something like that.
There was some news. Student loan payments information is starting to come in. How are people paying back their student loans? This is the chart for student loan repayments from the US Treasury, from the Department of Education. If you can see here, just in this last month in August, people are starting to pour back into paying back their student loan payments, meaning that people did have the money. They're not starving to not pay it back. There are people actually paying it back, which you could say hurts SoFi a little bit if people are paying it back federally. Or you could say that there's a definite opportunity that
A lot of it is bachelor's degrees, I would imagine, because SoFi's going after masters.
Sure. But it also depends on how long you want to amortize it out for a higher rate. And I don't even know, is it 5% that you can get right now? I don't even know if that's true or if that's your old rate that you got previously.
Regardless, and I'm not going to say, is this data correct because it says US Treasury, so I hope it's correct. But am I blind, or do these lines hit at the highest points of the past 13 years? I mean, you go across from the top of the red, highest point, you go across from the top of the black line, highest point.
What is the difference between red and black?
So the red is the 20-day moving average. So the black is actually what you're looking at. That's the real data there. But what people are saying is that whenever you actually zoom in and look on the daily charts, which is what you're not seeing right here, it's already starting to come down. What I think this is a lot of pent up demand, an opportunity for people to, like, now they know their answer. So there's a rush to pay off. It doesn't necessarily mean that this rate is going to keep up, right? This is more like almost like revenge travel in a way. We're not going to see this new spike stay up here, but it is definitely a rush for people that have gotten all of this, opportunity to not need to pay back, is now knowing what the answer is. And so now there is an actual, payback. And it could lead to a huge opportunity for companies like SoFi that potentially we didn't get to see in Q2. We might see materially in Q3.
Like, you don't think this is going to affect the volume of originations that SoFi will be able to get for student loans? Because that was the concern, right? Is that too much is being paid, therefore they can't.
It's more of a two-prong. I don't know if how I want to look at it. I think people paying off their student loans and they know what's actually happening with forgiveness, that they are paying it off. Yes, we're not going to actually get those originations of the people that are paying it off, but I don't think this is nearly like
Tannor, paying it down or paying it off?
I'm going to assume this rush of payments is paying it off. Because why would you rush into just making your first payment?
So that's assuming people were fiscally responsible, and human nature is not being fiscally responsible and saving up a amount of capital to, once it goes into effect, just pay it off the balance. What's the average balance?
I think it was 30,000, something like that.
Most people are not saving 30 grand just to repay all at once. You see a case where they would just say, you know what, let me just get out of it because it's one of the highest levels of debt I have. So yes, I could see that, but I don't think people that have 20 or 30 grand are just going and writing a check and sending it in tomorrow. Did anybody see the interview on CNBC?
Noto, let's share that clip.
No, I wasn't talking about Noto, but we can talk about that one.
It is audio only, but it's either the full 8-minute interview or it's a minute and 30 seconds where he says nothing.
Yeah, they didn't release it on video, but it's on the podcast version of Mad Money.
But after speaking to CEO Anthony Noto, I came away feeling just as bullish as ever. I hope you listened to that interview because the stock quickly caught fire afterwards. In fact, SoFi stock jumped 20% in a single session when reported at the end of July, $11 and change. In the last month, it's been hard hit, like all the banks, by rising long-term interest rates. I get that, and Wall Street's not worried about the pace of loan growth, the entire industry. Probably some profit-taking involved. But remember, the stock doubled since we had Anthony on, and to me, that's what matters. That's what, in our business, counts. SoFi's now raised its entire post-quarter earnings and then some. Told us the quarter was going to be great and the year would be great, and you were dead right. And you stood up to the short sellers. That matters to me. Welcome back, Anthony Noto.
Jim, thanks for having me.
All right, so now, during a very tough period in banking, for a lot of banks, I mean, honestly, you guys have grown 9 consecutive quarters of revenue growth. You're about to become GAAP profitable. Everyone else is going the other way. You're going forward. How's that possible?
It's possible because we have a one-stop shop for your financial needs, and we've seen very strong demand for financial products, rising rates, couple of banks going out of business, the fact that the cost of credit card debt is higher, and the opportunity to invest in new things has caused people to look for other options. And because we are a one-stop shop, we're going to be at the top of the list for that. One of our products is incredibly differentiated right now. Our checking and savings account provides 4.5% interest, the ability to get up to $2 million of FDIC insurance, which was really important after we saw the demise of two banks. And then you can spend as much as you want with no limit and not have to keep the money in the bank. Yeah, we're able to grow because of a couple of reasons. One, we're going after a demographic that's been largely underserved, and we're giving them products that are going to meet their needs for the major financial decisions in their lives and the days in between. We can save them a considerable amount of money through personal loans to offset their credit card debt, which is rising in interest rates and the amount. We can also help them refinance their student loans at a lower rate if they qualify. And then, of course, giving them great options. As I mentioned, checking and savings, they get 4.5% interest. But we're also offering IPOs and invest and giving them access to products they wouldn't otherwise get. We're mobile first, and we also provide this member relationship. So when you use our products, you become a member. We give you a free certified financial planner. We can give you free career advice. All of our products are available on our phone, easily accessible at any point in time. So you can pay when you want, how you want. And essentially, we're helping people get their money right because we help them borrow better, save better, spend better, protect better. One of the products that we offer is unsecured personal loan. So those with credit card debt are consolidating that variable cost debt into fixed cost debt over specific terms so they can pay it down over time. Our student loan refinancing product provides the same thing. If you have a student loan, you want to lower your monthly payment, you're able to do that either via lower rate or extending the term. There are always trade-offs with those decisions, but we're giving people that opportunity to get their money right through a variety of different vehicles, and that's very appealing to them.
Are you doing anything with artificial intelligence that you can make these judgments about so many people? You have a huge membership.
Sure, we're using artificial intelligence in three ways. One, our technology platform, where we enable 135 million accounts in the United States and 8 billion transactions a year. We're using artificial intelligence for those partners to reduce the instance of fraud. We're using machine learning and artificial intelligence and the data from 8 billion transactions to identify fraud at the transaction level. We're also using it in customer service to reduce the number of contacts per customer and time to resolution, and a product called Connecta.
Just so what I think is so funny where he said, oh, we're building a fraud and detection system off of 8 billion transactions. That's a tiny fucking amount. That's so small.
Jim at this point is throwing these layups. Anthony Noto is just talking the same book. It's cool, but I feel like every subsequent fireside that Anthony Noto comes on, we have to, pay more and more close attention for nuggets of information, just because 80%, if not more, is the same stuff because there's different audiences. But
the first half is that, the second half is new. Fine, he has to give that spiel, and then intro. People get to ask him the real questions. But it's always that same, like, we are the next one-stop shop digital bank.
Either like whether it's earnings calls or fireside chats, it's always the Q&A at the very end, like the audience Q&A. That's the best part. Like, that's the only chance you can have some novel information.
Yeah, no, I definitely think the second half is better, but it's also just extremely long.
So yeah, it is what it
Jeremy Rishel sold more shares. What do you guys think?
Yeah, and somebody else, the chief risk officer.
Look, if those shares are part of stock-based compensation, they have every right to sell them because it's part of their package.
Is it part of the package, or is it like they decided they want to sell? That's the only, because if it's part of the package, it's whatever.
Well, it's not a part of their package to sell, but
no, like, was it determined 5 months ago if the stock was
so
Kevin,
if they're pre-approved stock sales, I think is Amit's point, then that's fine. If they're random sells in a quarter where like they're expecting to end off the year profitable, and Anthony Noto has himself used the buying and selling of SoFi stock, particularly the buying of SoFi stock, as a tool to stoke retail investor enthusiasm, to stoke the morale. And if they're going into a quarter where they have this really, really big, audacious goal, and then you're selling outside of a predetermined schedule, then that can do the opposite effect of what Anthony Noto was doing back in December and March.
Let's move on to this, because I want to give a shout out to Tevis. He had Jeremy on his channel and he asked him about SoFi, and I think we should play a little bit of that and see why Jeremy is hesitant about SoFi, because maybe it sheds a light for why other people in the industry are also hesitant.
Yeah, tough decision. So it's interesting. SoFi, literally last night, I was looking into potentially creating my first SoFi account. Actually, I'm looking at them for either doing maybe a CD, but probably a savings account with SoFi, because I like to have my money kind of spread around a little bit, especially after what happened with some of the regional banks and whatnot. You never know. And so I was thinking about putting like 50K in SoFi savings. And so I'm probably going to create an account with SoFi, going to experience the product maybe over this next few months. It's one thing to like look at a company and, read about it and, oh, they got all these different things. It's another to kind of like get into the product, experience it. How do they reach out, emails, upsells, like all those sorts of things. I'm really interested to kind of become a customer and see how things go there. But bottom line, obviously, is not in a good place still. It might get in a better place soon. I think I was already in too many bottom line bad companies to begin with. Certainly going into last year, I was not in a good position, like, 21 into 2022. And so I'm really trying to watch risk exposures in terms of like new stocks that are, let's call it money losers on the bottom line. That's really what it comes down to. But we'll see once I experience the product, if their financials start coming around, especially with student loans coming back. And I think it definitely has potential, but we'll see. It also really comes down to when it comes to SoFi, how is it going to be valued long term? And I think that's a question I'm still trying to figure out. Is this going to be valued like a bank? Because banks trade at 10, 11, 12 Ps, 8 Ps, like it's a joke, right? If SoFi is going to trade like that, then it's going to be tough sledding for years, but if it trades like a high growth company, there's obviously room for multiple expansion.
I can summarize the other reasons. Yeah. A lot of his decision is based on just being burned in 2022 with some of the speculative high growth names that he's bought. And 2022 was just a rough year for growth overall. So I do think that there is a level of that, once burned, twice shy, whatever that expression is. He's just hesitant as a result of that. I double down on the profitability point. My next question there was, if you're waiting for bottom line EPS profitability, you're going to have missed the boat because everybody buys in anticipation of that. And, for him, it was more like, I'm going to buy this for a set number of years and invest for the long term. And so if I see 1 or even 2 quarters of profitability, similar to like the Palantir situation, that's when I'm going to be more comfortable that it is sustainable growth that analysts can project years to come. And then I can make a bull, bear, and base case on owning the company long term. But right now, even though all signs are pointing to that profitability, just the fact that they don't have it yet and the fact that he hasn't tried the product are the 2 main reasons. With that backstory of 2022. Now, I will make a prediction. Let's make it before the end of the year. I do think he will be in SoFi. And the reason why is because he mentioned that he has listened to the previous earnings calls too. And he said, I'm really impressed with Anthony Noto and just how they're talking about the product in general. I think now that he's trying the product for the first time, in conjunction with like, this is on his watch list. He's always sort of watching the movements on this name, the pieces of news on this name, and listening to the earnings calls. I do think that as he reads more into SoFi, as he tries the product, I actually asked him, like, I'm really curious to see if you're going to cross-sell into any other of product lines, because he's starting off with like a savings account. I wonder if he's going to try Relay or something else. As he experiences that ecosystem, I do think that before the end of the year, he's going to be in the stock.
The good question you brought up, though, was like, well, on Tesla, you took the risk, and on SoFi, you're not for the profitable. And his argument was like, I could see the map for Tesla. I don't know if that argument's that good, because Tesla had to like really pull it off for it to. I don't think SoFi is that risky compared to Tesla, even if they're not profitable. And management said Q4 it's going to happen. So I think he's just really hesitant because he's gotten burned with some of these growth stocks. But with this one, I think that bias of his hesitancy is over determining his ability to objectively see what's happening here.
Absolutely. And I think one of the other points, he just said it in that clip that we played, right? He doesn't necessarily know the valuation, whether it's going to be more comparable to like JP Morgan or whether it's going to be comparable to like a fintech in terms of the multiple, right? And that can really skew what your future projections are.
This is one thing that I've just disagreed with a lot of people, is just like the multiple expansion. Even if it does stay down as a growth stock multiple, but keeps up a growth rate in terms of actual fundamentals, the stock will just follow the growth. If it's staying at a 1x price to book, but growing at a 40% rate year over year over year, okay, then that's the rate that we're going to grow at. The multiple is to try to get that growth ahead of where it is. And so people will buy it faster and faster. If for some reason the stock gets pulled down to a price where people think that they don't see the value in it, that's where the opportunity is. That's where the alpha is. Remember, this year, the stock was in the $4 or $5 range. It's in the $9 ranges, and people are looking for it to double again. It's like, no, if you were a smart investor that could see the SoFi opportunity before it happened, you're already up 100%. I still do think there's actually a large percentage of growth here for SoFi, even at these valuations. but you don't need the multiples to continue expanding. I mean, it is growing at a good rate.
I mean, look, maybe, and I don't know much about him, but with Tesla, maybe he thought, okay, if they're the one that's going to put EVs on the map and they actually pull this off, how much competition is there? Versus SoFi, there's a ton of competition everywhere you look. So maybe that was his line of thinking. Who knows? I've never talked to him. I don't know.
Yeah, I think there's another point there around consumer aspect. Like, he is a high income earner, and he's now finally trying the SoFi products. And the product that he's starting with is the savings product, just due to that APY. And, I think people realize that in this market, the high earners generally have a high correlation with financially savvy individuals, that they make the best move on the board when it comes to their money. And, people realize that at this time, there's not a lot of growth out there relative to the risk you want to take for that growth. And so as a result of that, like, SoFi is just going to funnel in more high earners, Jeremy being one of them. So regardless of, if he invests in the stock today or tomorrow, I think just him trying out the ecosystem is such an underrated point.
That is honestly what people should worry about much more if they're in the stock. It's not who else is buying the stock, it's who else is using the products. That is much more important. Okay. And so if you continuously hear SoFi's name come up and Wall Street doesn't care about it, consider yourself, expanding your alpha. There's an opportunity where the stock will continue to run. I don't know how people don't see it that way. Let's say PayPal continues to fall in terms of a stock price, gets down into the $40 ranges, and Wall Street just absolutely hates them for some reason. It's the worst stock ever, blah, blah, blah. Okay. They're just going to take all their share buybacks and just buy it at this lower rate until they take themselves private. That will do you absolute justice on your share price. You don't necessarily need investors to love your stock. Look at Steve's stock, Cisco. If no one's going to buy the company, Cisco will buy the company.
But something that Jeremy did say in that interview is very important, because we don't know how the market is going to value SoFi going forward. And I think a lot of that depends on their execution of the tech platform.
With another super chat for $27. In the future, do you think the profit margin on SoFi, technology division, Galileo, and Technisys will be higher than their banking financial division? Just how big do you think it'll get? And to piggyback off Jeremy, will the market value it that way? Steve, you can go first.
I don't think there's enough data right now to be able to speculate on that. We don't know what they're going to be charging large bank clients if and when they get them, and what the margin's going to be. Like Jeremy was saying, this could go either way. This could get a bank valuation, it could get a hybrid, or it could get a tech valuation. To me, the valuation question lies with their tech platform. If they sign up some large banks and some regional banks and they're showing incremental growing revenue, because if they get these contracts, it's not going to be a flat-based contract. They're going to have annual escalators after year 3 or whatever it is, and it's going to go up every year annually. They're going to, after the honeymoon phase, just like in real estate, they're going to have annual increases, price fixed escalators. They're going to grow the revenue line. And if they're the ones that own the technology that's servicing the back end for a respectable percentage of the banking sector, I don't see how it doesn't at the very least get a hybrid multiple. Maybe it doesn't get a full tech multiple. I think it's going to get at least a hybrid. That's my own opinion based on the due diligence that I've done. And I think it's going to take a couple of quarters to really see how this is going to play out.
Okay, so this is what we know. If, for
we
example,
we know revenue and contribution profit, but we don't know what they're going to be charging for the full platform to a big bank or a regional. That's what I'm saying.
Sure. So if you're dealing in payment processing or any of these things for small to mid-sized businesses, and then you move up to large enterprise, does the margins go up or down? They go down every single time because
economies of scale.
Yeah, because the higher you are, the more pricing pressure you have. So it's honestly, the higher up we go, the more pressure it's going to put on margins. Aside from the fact that there is cross-selling and they need more products. Management has been clear that right now, contribution margins are about 20% for the tech platform. They're wanting it to get to the 30% in the long run. So whenever you're comparing that to the financial services division or the lending division, you're not even in the ballpark.
Yep.
Like lending is 70+%, and financial services not even there, but they want to hold 20% in the long run. So banking versus tech, I think it's definitely still in the banking side.
And I think like they're not mutually exclusive things in terms of having SoFi Command a hybrid valuation from a multiple perspective, meanwhile having a massive discrepancy from a contribution profit perspective, because fundamentally the tech platform enables the high margins on the other aspects of their business. And even if it just does that, that's beneficial in its own self. Like they could roll out new tech products and then bundle those all together to get more contribution profit as an end result. But even if it was just a tool to enable them to get 70% plus contribution profit on the lending side consistently going forward, that alone should command a hybrid multiple from a valuation perspective.
Have you guys heard of Chase Payment Tech? It's Chase Bank's payment technology. They do point of sale terminals, they do processing, they do all these sorts of things. And from what I was reading about recently is that if you get a business account with them and you get a treasury account with them and you need payments processed, they will bundle that in because you're already a large client practically for free. They will do better pricing than Adyen and Braintree and all these other payment processors. If SoFi, if for example, they do get into business accounts, they start doing this, the opportunity for growth because they have a payment provider as well is just crazy. They can bundle products into payments with Galileo. Like there is, I think, some cross-sell between Galileo and their existing business accounts and everything that they can offer very soon. Right now, Galileo has kind of carved itself out a niche for offering payment tech to other fintechs, but it doesn't need to be. It can be any mom and pop shop or other business that wants to set up embedded finance or anything like this. There's so many options to grow.
Based on what you just said, theoretically, could SoFi get into the business sector, offer a point of sale system, and undercut the market? Is interchange rates stagnant, or does each payment processor tag on X amount cents on top of an interchange rate for credit card processing?
Definitely, yeah. So each part of the process, everyone takes their own rate. So it depends on whether you have like ISOs within the business, they'll take a rate. If you don't need those and they can cross-sell within their own business, like Adyen will offer the point of sale service and then they'll do the acquiring and the payment processing and everything internally. So they have some of the lowest rates possible.
Would SoFi even need a POS to do the interchange? Like, do they need the hardware aspect of it?
I was just saying that just for a full suite of products from A to B.
The truth is SoFi doesn't even have that technology right now. They're more on the card side, the consumer side, setting that up, issuing it, doing all those things for the client. You're really talking about like merchant side, payment processors, which we're really not into very much right now. Whenever you own the client, a lot of these things that are happening is beneficial to SoFi. So PayPal's down, Adyen's down, all these companies are down. SoFi and the companies that own the clients are the big benefactors to that. The rates are coming down, they get to win. Unbelievable things, I think, are happening in the fintech space. The big banks, the one-stop shops are here to win greater than any other player in the entire space.
This week, SoFi won the 2023 Finovate Awards. Basically just another award that they won for the best digital bank. And SoFi was commenting on this, but obviously
by far the worst award to win, but it was good.
They win every award at this point. So just,
I mean, it's just a testament to their product quality, right?